Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of the video, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. Quick reminder that we will be closing the polls for our t-shirts on Friday. For the 25,000 subscriber mark, we're going to make up some t-shirts, and you need to vote to indicate your interest so we can order the correct amount. You can vote either in the Discord, and you can also vote on design in the Discord as well, or you can vote over on the YouTube community tab, and we've set up a poll. You can just indicate your interest there as well. So with that being said, let's jump right into today's S&P analysis as we always do with our sectors: who was leading, who was losing, and where was the weight. The XLRE for the real estate sector led the pack today, up 1.62%, whereas down at the bottom of the barrel, we see the XLE for energy down 4%, but technically speaking, from today's open, it was actually up 0.85%. From today's open, the true laggard would have been your XLP, so consumer staples should have fallen at the bottom of the barrel. Nonetheless, it's not great to see real estate at the top of the list. We know that's an extremely lightweight sector, so why was that leading the charge to the upside? Not a great indication there. And then energy at the bottom of the barrel is actually a decent look here based on the read from the prior day's close, as well as consumer staples being skewed down towards the bottom, because we know both of those are really more risk-off assets, more defensive in nature. So we'll talk more about that as we move through today's video. I think some things are fairly deceiving. There's a lot of red flags right now in the marketplace. In terms of the heavier weighted sectors, though, what do we have? So the XLK is the tech sector, the heaviest of them all, down 0.42% from the prior day's close. From today's open, up 0.67%. The XLF is just one step ahead. This is the second heaviest weighted sector that we're watching, down 0.22% from the prior day's close. From today's open, up 0.93%. And then last but not least, today's rally was really brought to you by healthcare. Second heaviest weight by market cap, third heaviest weight that we're watching, up 1.39% from the prior day's close, but from today's open, up 2.04%. That's really what pulled its weight in the S&Ps to the upside on today's session. But again, let's not be deceived here. I think there are some structural things going on that are not the greatest. So taking a look at our structural charts now, XLRE is going to kick us off for real estate. Again, if this was leading the charge to the upside, why was it that we couldn't even get any acceptance into this gap overhead here? It's still a really lightweight sector, so even if it did close in the gap, it's not like a huge boost in confidence, but the fact that the buyers couldn't even remain in the gap for the close or close it all the way strikes me as a sign of weakness from the buyers. So again, although this was at the top of the list, I'm not overly impressed with the structure that was put in here. And although, again, we also had what felt like a rip-your-face-off rally in real estate, look at the volume that transacted on today's session. It's absolutely minuscule, right? It's kind of pathetic, to be quite honest with you. So I'm not impressed with the buying activity in real estate. Am I impressed with the buying activity in the healthcare sector? Let's take a look here at the XLV. Before we zoom in any further, I would just point out that we've finally gotten the back test of 125. But what happened there is we put in an upper wick, right? The buyers were not able to close up above that level or even at or near it. I suppose it might be near, but for now, this strikes me as a break, retest, and now there's potential for lower, given that we've already rejected that level on today's session, the first backtest, right? If this was going to be a more bullish indication, we should have closed on or above 125. It simply didn't happen. Now, don't get me wrong, the candle structure here is slightly better than what we just saw in the XLRE, because we do have a low, higher low, higher low, higher low, right? We are technically trending higher from a bar by bar perspective. But this upper wick here is what's causing me some concern, and especially at this particular location, 125. So into the remainder of the week, 125 will certainly be on my radar in the XLV to either start confirming any sort of rallies that start happening or denying if we fall back down and cannot recapture it into the remainder of the week. It's as simple as that. If we can't get above, there's no real reason to be bullish just yet in healthcare, which again is the second heaviest weighted sector in the S&P 500. We simply have break, retest, and possibility for back lower, right? So am I impressed with the buying activity here? No, not really. Not really. It's a step in the right direction, don't get me wrong, but not overly impressed just yet. Next up, we have the XLU defensive sector. You'll notice that it's starting to get a little bit of a bounce at its trend line. We got a little bit of a fake break through it. As long as it's not leading the charge to the upside here at the all-time highs, I'm not overly concerned, and it certainly doesn't look like it's going to do anything like this in the next couple of days here. So anything that moves higher in the XLU is decent, little bit of upward pressure for the S&P 500. Remember that this is defensive, and it's also, again, a fairly lightweight sector, so I'm not concerned with any type of activity that's going on here. The bounce off the trend line seems natural to me. Next up, we've got the XLC. This one is worth reading into just a little bit more than saying, you know what, it's okay, it's eh. No, let's think about this one a little bit because it's a heavier weighted sector. What do we have on today's session? First of all, I would say volume again here, pretty pathetic. Now, if we look at candle structure and tie in the most important part of this, what happened on today's session? Technically, we opened underneath the prior day's low on a gap down, right, which would have been an indication that bears were kind of in control. The buyers step up, and it looks like we're going to put in a bullish engulfing bar, but can we do it? Absolutely not. We closed the day extremely weak, pulling back into the lower third of the daily range. So am I impressed with the buyers in the communications sector? No. We had what started off as a fairly impressive rally, a bullish engulfer early on in the day. But the fact that that did not hold indicates to me those were pretty weak-handed buyers, right? They're just short-term momentum buyers. As soon as the momentum dried up, the sellers easily took it back down towards that lower third close. In the grand scheme of things, this still strikes me as just bear flag consolidation in this overall area. I'm not impressed with the buying inside of the communications sector. Next up, we've got the XLP for consumer staples. Anything interesting here? Yeah, we did get the new higher high, higher low. But again, if we think about how this closed out, why was it that we had a nice bullish break of the two-day balance right here? Follow through day. And now, yes, again, we are still respecting this as support here around 69.60. But overall, why could we not close a little bit stronger at the highs? So this one's okay. We are just getting a little bit of a resting bar up here at the highs as we start to come off these lows, but it could have been better, right? So overall, a step in the right direction, but it's not like having me feeling warm and fuzzy about any major reversal in the S&P 500 thus far. And also remember, what we talked about in the weekly watch list video has not just disappeared. We did technically make a new lower low from here to here. So even if this does rally and do something like this, there's still a possibility that we put in a lower high here from here. Right? So we're not out of the woods in any of the sectors just yet. And although we've had what felt like two kind of semi-impressive rallies in the S&P 500, when you peel back the layers just a little bit further, they're actually not that impressive, right? So XLP, that's going to wrap that one up. Consumer discretionary. What's going on in discretionary? Same idea as what we discussed in communications, to be quite frank with you. Volume is pathetic. And also look at the failed engulfing bar, right? So now two inverted hammers, two larger upper wicks. We gave back more than 50% of the rally towards the highs, and we closed inside the prior day's range. Overall, we have still not moved outside of or above this high from right around in here that closed the gap. So I'm not impressed. I'm not impressed with the buying activity. Again, the market's trying to rally higher, but it just doesn't have what it takes to sort of do anything impressive at this point in time. Can we change our tone? Yeah, absolutely. If we take out this level here with acceptance, I'm certainly willing to change my tone in the market right now. But what we're seeing is just, again, quite frankly, not that impressive. Kind of some red flags out there in our marketplace. So let's continue along. XLF, anything interesting happening in this one? Financial sector, definitely worth spending some time on. Open below, close the gap, work into the prior day's range, and reject right at the prior day's high. Now, this is actually an okay setup, indicating that we have two back-to-back equal highs here. It really strikes me that this might want to turn into, if retested, a pressure cooker top that then takes us to the top of this three-day balance. So there's the possibility here that this turns into a look below and fail, and if we can take this out, it brings us home to the top end of the range, right? That's the target right there at 32. If that were to happen into the end of the week, maybe that's a decent amount of upward pressure for the S&P 500. But again, until that level breaks, I've got to remain more neutral to slightly bearish and just not impressed with the buying activity on today's session. Again, look at the dramatic taper in volume on today's session as well. And I get it. We have a shortened holiday week here, but it's no excuse for like volume that's this paltry. I mean, this is so low, right? So that's what we've got in financials. Overall, again, maybe there's something to do here on the long side if we breach the two-day highs, but I'm certainly not feeling the love so far from the structure that's put into place. XLK, perhaps the most important sector of them all to be watching here, the heaviest weighted in the S&P 500, back-to-back inverted, not an inverted hammer there on the Tuesday session, but on today's session, certainly an inverted hammer. If we take out this set of lows right here, obviously it's back down towards the two-day balance in here. We don't as cleanly have the look below and fail on like a three-day balance. I would not consider this a look below and fail. It's a little too sloppy for that in here as compared to what we just saw in the financial sector. But again, two back-to-back highs here. It's worth carrying forward that there could be a breakout up and over it. but why were the buyers not able to close it, a little bit stronger up towards that level on today's session? It just simply didn't happen. Again, think about the retracement here on the intraday. We definitely gave back at least 50%, if not more, of today's rally. Maybe it's closer to 60% closing on that lower third boundary. So overall, again, am I impressed here? Not really. If we need to change our mind, it would only be because we have a little bit of an inverted head and shoulders and we sort of crack this. But we already discussed, if we take out the 2-day highs, maybe there's reason to believe it's higher here. But for now, I'm just, based on today's close and the upper wick and the failure of volume, I'm just not, again, feeling warm and fuzzy about it. And I know I keep repeating the same thing here, guys, but, everyone was sort of cheery about the little rally we got early on in the session. And the fact that it all basically disappeared, it's just not, we're not there yet. We're not quite out of the woods just yet. XLI, industrials, lighter weight sector. We're not going to spend a whole lot of time here. Obviously, if this one takes out your 87, look for higher, and we would be moving towards the top of the prior 3-day balance and out of what is now a 4-day balance. So this one could move higher, and the close is a little bit better than things we've seen so far. Just a little bit, not a whole lot, but a little bit, based on closing at the midpoint instead of the lower third, and volume actually upticked on today's session instead of downticked. XLB, materials. What's going on here? Nothing really doing, to be quite frank with you. 4-day balance is starting to be put into play. There's really no trade to be had until we breach these highs for higher or breach the lows for lower. And even then, remembering that this is such a lightweight sector, it's not going to do a whole lot for your S&P 500, so we're not going to spend too much time on it. Next up, we've got the XLE for energy, perhaps one that we should spend just an extra second on, because energy, as we know, is a defensive sector. And of course, as oil comes in a little bit, hopefully that relieves some pressure on the marketplace itself. Notice that this filled the gap overhead and then rejected off of it. To me, it's an indication that we might want to head lower here, right? If we think about this, it's an extremely tight H pattern, but we technically do have a lower high. If we breach these two equal lows, we're probably headed a little bit lower, right? And that would, of course, be a good thing for the marketplace, but only if we can get some of these heavier weighted sectors in gear with some serious buying that closes strong, consolidates up towards the highs, and doesn't back off as aggressively. It needs the volume to pack the punch behind it as well. So energy, keep an eye on it. If it continues to break down, again, maybe it's a good thing, but only if these other heavier weighted sectors can actually pull their weight, which on today's session, they didn't really do a great job of doing. So with that being said, let's take a quick peek at our ratio grid and see what's going on from this perspective. If you want to know how to set this up, I've got a video for you in the top right-hand corner, but let's dive right into it. So what you'll notice actually on today's session is that many things actually ticked lower, although we had a green day, right? Look at your XLK. It actually ticked lower on the relative strength grid. The only thing that moved higher in our top 4 heavy weighted sectors, risk on sectors, was the XLV, and that makes sense because it was at the top of the list today. So has this changed the tone to risk on? Absolutely not. We only have one of the 4 doing what it should be doing to indicate risk on, and that's not enough to change the tone. Down at the very bottom of the barrel, we have the 4 that are sort of risk off indications. Notice that your consumer staples are going sideways, but still above an upward sloping 50 SMA. Energy is starting to come in a little bit. Again, this is what we just discussed on that structural chart, that this is a decent look here, but only if some of these other things in the top 4 can actually perk up, which they didn't do on today's session. So we want to continue to see energy come in like this, but something up here has to give. We've got to get a little bit more relative strength in those risk on sectors. Real estate perked up. Again, that makes sense. It was at the top of the list, and utilities as well, kind of chopping around that upward sloping 50 SMA. Overall, the ratio grid would continue to sort of indicate the theory that we should be in risk off mode. We're not quite turning on risk on, right? Let's continue along and take a quick peek at the TNX. So this is going to be our 10-year rate. And again, another sort of concerning look here. Why was it that on a day where the 10-year rate comes in a little bit like this, why was tech not stronger, right? We know that the 10-year, as it moves higher, puts downward pressure on the XLK. So as it moves lower, it relieves some of that pressure on the interest rates that a lot of those tech companies sort of rely on to borrow large sums of money, right? Make their profit margins better. As this comes in, why did tech not have a more impressive day? It's not adding up here based on the things I'm seeing for a better bottom yet inside of the S&P 500. Again, another red flag here in our TNX. Let's take a look at volatility. So the VIX itself, what's going on? It's still well within its volatility box. It's backing off. Don't get me wrong. On the 2 rally days, it's red, right? We're not hanging out up at these highs, but we're also not cracking down underneath these lows, right? So volatility is still very much in the marketplace, and I don't think we're out of the woods just yet. Remember that for a capitulation type bottom, it's really got to get up towards that 40 handle. We've discussed that in length in the past, or if it's going to come down naturally, we really have to get outside of this box underneath the 25 handle seriously and back down into 2050. Currently, it's on the right trajectory victory, but we're still only at the midpoint of this overall range, just indicating that, hey, things aren't yet fine and dandy inside of the market. And even if we take a look at the VVIX, which is the volatility of the volatility index, this is falling out of bed once again. This is not a good look. This means that no one's hedging in the marketplace. So if everyone gets caught with their pants down because tech doesn't rally and energy finally starts to perk back up again and we see lower in the market, this isn't a good sign, right? This is not a good sign inside of our VVIX. So overall, I'm seeing a lot more risk in the marketplace right now as opposed to upside reward or stronger signs of a bottom. Let's get on over to the SPY itself now and actually talk about the levels that we're going to be watching into the remainder of the week. So zooming in a little bit here, it's a little easier on the eyes. There we go. What do we have? So we've been rejecting at the top end of the weekly expected move, but am I all that concerned with that? Not really. Remember that the market's got the weekly expected move wrong now 2 weeks in a row. We busted out of the one that was from up here, and we also busted out of last week's. That's the lighter gray shaded box that you have on the screen in front of you there. So overall, again, I'm just not, even if it does move higher, that's fine. I'm not like, oh, look, we're outside the weekly expected move. The market has gotten it wrong 3 weeks in a row now, so if it does it again, it doesn't strike me as a surprise. But do I think it's going higher from here? I just, again, based on everything we've seen so far, I'm not of the belief that the buyers are all that strong. We're going to see even more evidence for that as we pull up the internals in just a moment. So instead, where my head's kind of at is, all right, if we can give back some of this stuff underneath 371, all of these rallies are given back. The week turns red, right? I do think we're headed back down towards this 364, which puts us back in the midpoint of the weekly expected range. I think that probably keeps the options market content into the Friday session. Some other things I want to point out here, just like the psychology we've been talking about for almost every one of the sector charts we've seen, notice that we opened on technically a gap down today. We rallied, put in a bullish engulfing bar at one point in time, and then pulled back about 50% and closed inside the prior day's range. So this is not as bullish as it could have been. If the buyers were truly strong here, they should have held it up there. Also, why did we gap down on today's session in the first place if the consolidation was high and tight for a bull flag? Let's show this on the 30-minute time frame on the Tuesday session. Notice that we get a little bit of a short squeeze rally, right? And then we go sideways, so the buyers look and appear to be holding it. We opened on a gap down, so all of those people should have been wrong, right? On the buy side, we rally once again and then kind of give it back into the close. So I'm just not really feeling overly confident about this market right now. And I think a lot of people are feeling this way. As we've sort of discussed and vocalized some of these thoughts in the Discord, some other people are saying, yeah, the market just doesn't really seem right on these rallies so far. And I would agree with that based on everything we've seen so far on the charts. So just to keep it simple, if we breach the lows here at 371, there's technically a little bit of gap to fill to the Friday of last week's high. And then after that, we're looking for that 364 midpoint of the weekly expected range. If there is a move that rallies once again to the upside, the targets are probably focusing on this gap overhead, but I would really need to see personally big signs of improvement in our sectors as well as the internals, which we'll get to in a second here, for me to feel comfortable about taking a long up around these areas. Based on the upper wick, again, I'm kind of the belief that we might be headed lower. And also remember, as we sort of discussed on the weekly watch list video from Sunday, if we technically count this as the true bottom right here, our 38.2 for bear flag consolidation on this overall move is going to kind of offer some resistance around this area as well. So 380 to 385 is a really, really tough area to be a new money buyer right now inside of the S&P 500. So that's been the technicals here. Let's get on over to our market internals. If you're not familiar with this screen, I've got another tutorial video for you in the top right-hand corner on how to set it up and how it'll help you make better intraday trading decisions. What do we see in the volume reads? Again, these are some massive red flags in my estimation. As we've been rallying, sure, the volume was impressive on the Tuesday session. We did breach and hit that 300 million mark, but on today's session specifically, as we had, if I just pop this on clean, the engulfing bar from opening underneath the prior day's low to then getting above the prior day's high, why was volume here? Volume could hardly get positive on today's session. So the inflows into the market are just simply not there to support any major or significant buying activity on today's session, in my estimation. Same thing is going to hold true in your advanced decline line. We open negative and hardly get to the positive territory for today's session. Now, don't get me wrong. Of course, this trend overall of moving off of trend zone down below, so 1500 to negative 2000, moving away from that is certainly a positive indication. But if this was going to be stronger buying activity, we should have gotten positive negative and potentially trended higher up towards that positive 1,000. It simply didn't happen on today's session. And again, I will concede that the sort of advanced decliner on the Tuesday session was solid. It was solid up there in trend zone. I'll give it that. But on today's session, again, specifically because of the engulfing nature of the price action, I'm a little concerned here with what was happening in the internals. The same thing is going to hold true with our tick. It's really not about this barcoding action up here. It's the net effect of the cumulative on the day. It actually closed out negative, and it hardly got positive even as this rally was taking place, right? As this first aggressive pullback came, it pretty much put us back to negative territory, and we were flat the rest of the day. So big red flags here inside of the internals. I'm seeing some pretty decent divergences that would say we probably shouldn't really trust too much of this buying activity just yet. We're going to keep an open mind where if these internals improve, if the sectors improve, maybe there's reason to sort of believe that we should shift our mindset. But currently, it's not there yet. It's simply not there yet. What do I have for you next? It's going to be the market profile. And this too is going to be a little bit of a heads up for us in terms of levels we can expect. If you don't know what this is, again, I've got a video for you, top right-hand corner. That's besides the point. On today's session, the main takeaway I want for you is, again, if we think about this as an engulfing bar, think about where value area low is. Boom, right here. That's going to be a really mechanical level. If this level, which is where we currently pulled back to and closed, in the ES starts breaking down, I think we're headed lower, and probably if we scrunch up the chart, remembering that we have this kind of look from back around in here, we're headed right to the top of the balance, so the prior day's low, and then if we break back down into it, this is a weak level as well. This is a mechanical level. Right? We have two back-to-back lows right at the same area. So a couple of market profile references that you should be carrying forward. Value area low from today's session. That's going to be roughly around 37.60. It's right where the market's sitting right now. After that, the top of the multi-day balance from right around in here. The reason I say multi is because we had some overnight sessions as well. It's not just a two-day balance. All of those levels are basically the same at 37.12, we'll call it, just for round number's sake. And then if that breaks down further, again, you're moving towards the bottom end of that range. You could make the argument that value was slightly skewed to the upside. The point of control did migrate higher with price, but we closed quite far away from that high volume node, the point of control. So overall, not really impressed with the value moving higher here. It's got to prove it to us with some of those sectors improving over the course of the remainder of the week. So that's all I've got for us in the S&P markets. Let's take a quick peek at our QQQ, the NASDAQ 100. The IWM will get through our core list, and I'll send you on your way with those four trade ideas. What's going on here? Same exact sort of idea. Inverted hammers on the prior 2 days sessions, upper wicks here that have failed multiple times to close above 282.20. Why is that a critical level? Well, let's take a look here on the 30-minute time frame. That's where the breakout happens, and we close above on the pullback from the FOMC last week, Fed funds rate. Now we've just sort of hovered around it, and we've closed below on today's session. So there's reason to believe, now that we're sort of underneath this area of support, there's a whole lack, I should say, of structure until we come back down to this next critical area around 274.50. Okay, so if we go back down to the daily time frame, what that looks like is breaking the 2-day lows should send us lower to here. That puts us right back in the midpoint of the weekly expected move, keeps the options market happy, and it's a shortened trading week, so maybe people have just taken it off entirely. Overall, not impressed with the structure that we've seen here so far. The next bullish trade, in my estimation, is only going to be if we can break up and over this gap. The gap isn't what you want to be trading for here, but rather the retracement up into this level right here. Currently, we're getting no love up at the top of the weekly expected move, and also, if we be congruent with our fibs, coming in from the top down to the bottom, we're rejecting right at the 38.2. So it still strikes me as bearish consolidation in this overall area. Again, I'm watching like a hawk the 2-day lows at this point in time to initiate any short trades into the remainder of the week. If things start changing from a sentiment and structural perspective on the sector charts, I will reevaluate, but for now, that's my primary objective. Next up, we've got Russell 2000, IWM, the small caps. What's going on in this one? Perhaps, couldn't even get out of its own way in the first place. Notice that we can't really get above that level there at 169. It has not attempted the top of the weekly expected move. To me, just thinking about this as a risk-on, risk-off indication for the marketplace, obviously it's falling into the risk-off category, noting that it's not as strong as what we've seen inside of the Qs and the SPY. Now, I will give it to the Russell, the sense that we did close a bit of a better candle here, but again, tapering off volume and the internals and everything else we've discussed so far. This is only one data point. I would say we've looked at multiple data points elsewhere that would actually fall into the bearish or still like really skeptical camp. So one strong data point in the IWM is not really enough. Again, the candle candle body itself, not really enough to change my perspective on what we've seen so far, still rejecting at that 169. Instead, I would just be neutral in here and just maintain that risk-off stance if we can't really get into gear above 169 into the remainder of the week. So that's going to do it for the broad market. Let's get through these core list of companies. What do we see in Apple? Similar sort of idea and look here. Notice that we have an inverted hammer on today's session. We had the gap up and follow through on the Tuesday. We took out that follow through day high and could not make it to the bottom of the next gap overhead. So 137 is your critical resistance. I would say that I would continue to carry that level forward as important. If we just get sideways consolidation here and do not take out the 2-day lows, it does set up a buy eventually for the breach of that 137. But based on today's candle structure and the lack of volume, I would say not really the most impressive look here inside of Apple. On the downside, I wouldn't really look for the short under the 2-day lows. I would just be more neutral in here. And then if we break this level, your advanced heads up is underneath 131.50. But instead, if we break down underneath 130 even, that's your trade into 126.86 coming from historical resistance, which was then support off to our left. That's Apple. Next up, we've got Netflix. What's going on here? Zooming in on Netflix, very easy chart to interpret. Nothing to do here until we can take out this range. We talk about it in the pre-market live streams all the time. We've had inside bar after inside bar after inside bar after inside bar. It's patience for this gap fill overhead, 185.72 up to 192.22, or shorts only underneath this level here, 165. Could it go early underneath the 168, container bar low? It could, but I would probably just want the better confirmation of breaching 165, right? So on an intraday chart, it might do something like this. Retest, that's kind of your entry right there around that 165, right? So that's Netflix in a nutshell. Wait for this box to break one way or another. Tesla, what's going on with Elon Musk? So some interesting activity here. Again, falling into the improving category, but not impressed with the daily structure. I think the fact that, again, perhaps better on the 30-minute time frame. This little pullback right here, boom, that was it right there. That was really impressive. And then the fact that we closed well above on the Tuesday session looked pretty good. Strong rally right off of 700, but the fact that we've retraced and put in a clear lower high now, 700 has to be your pivot. If that breaks down, thin structure on the way higher, there's nothing saying that Tesla isn't going right back down to 660 and filling the gap underneath, okay? So 700 is your must-watch pivot inside of Tesla with this relative weakness or just lack of buying strength on today's session, even after holding and rallying in the morning. I'm not feeling great about it. To me, this just all seems like overhead supply. Anyone who chased it up at these highs noticed that the volume tapers off as we move lower, right? So people were chasing it up at the highs, initiating new positions. They're underwater, right? Especially if 700 breaks down and we go through this thin structure, I think we could see a waterfall right into that 660. If it holds 700, that's fine. I would be more neutral in here. We can already see what's happened in the past. Really, really choppy, tough to trade that, right? So the next long trade is a patience play until I would just honestly wait for some better structure to be put into place, right? Maybe 5, 15-minute scalps are fine to the upside, but for an easy structure to identify, we just don't have it yet on the daily or 30-minute time frame. Next up, we've got AMD, another simple chart to look at because if we have our daily balance right here, we've got two back-to-back inverted hammers or just upper wick rejections of 85. To me, this just seems like we got a little extended through the 100% retracement from here to here, right? We're getting a little bit of a break retest, and now we should be headed back lower if we can take out some of these lows in here. So anything that's underneath 83 in AMD opens the floodgates for a move lower. Ultimately, 73 could be a target, but the rejections so far of 85 do strike me as promising for the bearish category. I would not be bullish on AMD until we can put in a higher low above and start to form a new uptrend like this. So for now, definitely in the bear camp in AMD. Next up, we've got Meta. Really weak close on this one. It was down the most on today's session on our watch list here, but nonetheless, breaching the low of the outside bar, bearish engulfing bar, with follow through on the volume as well. So definitely falling into the bearish camp here inside of Meta and also on the 30-minute time frame. If we take a quick peek here, notice that we have a break, retest, and then lower. So there's that double top that I'm always talking about. Whenever we're looking at levels to either confirm or deny as support or resistance, that's a great example of a double top right at it, even the lower high double top into the afternoon, right? Break the trend line, heads back lower. So fantastic little move here inside of Meta, and I would continue to maintain a bearish stance here, noting that the bearish engulfing bar is getting some follow through to the downside, and the sellers are also stepping up right where they should be at the prior lows of the 2-day balance range at 160. As long as we remain underneath 160 inside of Meta, keep that bearish stance. Our next target down below is 153, and then after that, we've got to find a new one. It's been quite some time since we've been down here. Let's actually just do it together right now on today's little video. That way we're not leaving you hanging here. The next major support I would call out is probably closer to 142. Let's go ahead and switch tools here before I make a fool of myself. There we go. 142, 143 is up next. So again, a whole 10 points underneath that 153 last target that we had on the screens in front of us right here. I'm not expecting we make it here into the end of the week. I'm just giving you a number to start watching out for into the short-term future here. Next up, we've got NVIDIA. What's going on? Let's drop this chart back to a yearly. That's a little bit aggressive, having so much price action. Again, two nasty inverted hammers on today's session. Not impressed from the follow through here. Again, why could they not close it at the highs as we gap and went right out of the gates basically on the Tuesday session? On today's session, we move into the prior day's range, close weak back outside of the Tuesday range. I'm not impressed. The trade here is to watch for the gap fill underneath 161.78 to come into 159.50, and then after that, monitor for continuation lower here. I do think that this is still a weak level on the chart around 155.50. We've tested it too many times with too much precision here for it to really hold up as a strong, meaningful bottom. It doesn't strike me as the proper end to the auction, so I would look for lower based on the pattern that would do this. H pattern, sort of lower sets of highs in here, any equal low reattempts in short proximity of time. That's where it opens the door for lower into 147.86. Next up, Microsoft. What's going on in Softy? Pretty nasty inverted hammer on today's session. Again, we got follow through up and over the green bar, closed weak back down inside the prior day's range. Not overly impressed. Is it a step in the right direction? Yes, we made a higher high. Yes, we made a higher low, but the close, not that ideal, happening on tapering volume down here. I would just be mindful of these lows right around here, 250 even, right? 250.36, that general area. If it breaks down, I'd probably start looking for this with the sort of assumption also that there might be a little bit of a reaction at that 247.50. This really strikes me as more similar to Tesla. So rally, nice high and tight consolidation, rally that takes it out, but a lower high and a weak close into the afternoon. This now strikes me as overhead supply if we start breaking down underneath that, which is why I was talking about short trade ideas into the remainder of the week. The only long here is probably, again, just being more patient for some better structure to unfold. There's currently nothing that jumps off the page at me saying, hey, this is the long entry currently inside of Microsoft. It's just not there. Next, last but not least, we've got the mini beast, Amazon, two back-to-back inverted hammers here. Same idea, guys. Just watch for the breakdown of the two-day lows headed back down into this 102.61. If that happens, this is a weak level because it's been tested so many times to the penny. So if we get there, think about it like this: lower high reattempt in short proximity of time should open the door for lower into 97.62. Maybe 100 acts as a psychological level in there. But remember that because of the split, 100 in the past wasn't actually 100, or perhaps a psychological level. So just be mindful of that as we come into it. It may or may not have some reaction around 100 is what I'm getting at. For a long setup, it's got to really get some acceptance above that 109.06, which was the top of the gap fill from in here, and also the resistance from last week's FOMC, right? It currently has no acceptance above that level, so there's no reason to be thinking bullish just yet. If we do start putting in a consolidation or acceptance above, it might change the tone, but currently bearish camp inside of Amazon. So 4 trade ideas. Let's move through them quite quickly. NIO is the first one. NEO. Why is this on our radar? Because it's been exhibiting relative strength here. We have a budding uptrend. We have a 2-day balance with 2 back-to-back equal highs at 23.10. If that breaks, we are looking for higher here, and the target would be, if we just scrunch this up a little bit, so first target's probably here, and that would also, it's a little shy of a range double, but it would seem reasonable over the course of a day. So about a $1 move here inside of NEO to the upside. Then after that is where things get interesting, up closer to 26. I'm not saying it goes to 26 on the course of 1 or 2 days, but it could over the course of time if this breakout does unfold in the first place. I would not be interested in the trade. I know that Zoom was really horrific if we break down and fill the gap underneath. Kind of off my radar in that instance. So that's NEO. Next up, we've got OXY for Oxy. What's going on in Oxy Petroleum? This is sort of just like the XLE sector that we were looking at. Look at this as a really micro H pattern. The fact that we're coming right back down into these equal lows, the fact that we put in a lower high, we filled the gap overhead and rejected, right? So we filled the overhead gap and then closed weak outside the prior day's range. So to me, if this level breaks to back-to-back equal lows at 54.38, look for a short, which should get us closer to, I would start thinking about this, right, around 48.61. Now, that's a bit of a stretch for 1 day's worth of price action here in OXY, but over time, going back down to this breakout point would seem reasonable to me around 48.61, right? So that's OXY. Next up, we have SQ for Square. What's going on in Square? Taking a quick peek here, 2 inverted hammers back to back. Again, it would seem to me that we could go short under those lows and just target the most recent low at 56.12 and then monitor for continuation to the downside. If it doesn't breach the 2-day lows or we just consolidate up here, there's no reason to be thinking short just yet. I would really want to see the confirmation underneath that pretty technical level there at the 59.38. So that's SQ. Next up, we've got Twitter, TWTR. Perhaps, this is the last trade idea. This is the 4th one on our radar. Look above and fail here on the balance range from the daily time frame, right? So think about this as your balance range. We close above it on the Tuesday session, inverted hammer closing back inside on today's session. That is a classic look above and fail. Target should now be the bottom end of the range here, which is at 37 even. And note also that this is a mechanical level. If retested on the look above and fail, I would expect it to continue here to the downside. It might give a little dead cat bounce and then continue, but I would watch this as a potential secondary breakdown point inside of Twitter. Not interested if we never breach the low of the inverted hammer or we pop back up and over 38.67. You'd probably have to consider either stopping out or just not being interested in the trade in the first place. So that's all I've got for you on today's session. Some pretty major red flags in terms of lack of buying pressure or significant buying pressure in the market right now. I think a lot of this is short covering that is short-lived and then new shorts come in. The market's just, it's in a tough spot 100%. So with all of that being said, if you enjoyed the video or learned anything new, definitely let me know by either leaving a comment down below or giving the video a thumbs up. Don't forget to vote on our shirts for the 25K mark. And with that being said, I wish you all a green trading week.